Welcome to vTalkInsight, Allocator's Lens Daily from March 30th, 2026. Cross-asset allocators are facing a classic stagflation scare, with a Gulf energy shock pushing oil into triple digits, bond yields higher, and equities under pressure, while traditional safe havens misfire. Let's look at how that mix is repricing risk and reward across equities, rates, credit, foreign exchange, and commodities. In equities, the tape now reflects a genuine risk-off phase. The S&P 500 has logged 5 straight weekly losses, is down almost 6% this month, and volatility on the VIX has pushed above 31. The Nasdaq 100 is in correction territory, and the classic 60-40 portfolio is having its weakest month since 2022, so stocks are no longer cushioned by bonds. The key tension is between resilient earnings and an energy shock that increasingly threatens them. Brent holding above $100, with credible scenarios of $150 to $200 if the Strait of Hormuz stays constrained, is raising costs across transport, autos, and semiconductors. One major bank estimates that oil, at roughly $110 for the year, could trim S&P 500 earnings forecasts by up to 5%, challenging recent upgrades and record-high profit expectations. Even so, earnings remain a buffer. Consensus U.S. forecasts have risen around 2% over the past month and still imply mid-teens growth, helped by energy and AI-linked demand, and some managers still describe the outlook for U.S. large and mid-caps, parts of emerging markets, and cyclicals as constructive. Valuations in growth and tech have adjusted. The Nasdaq 100 forward multiple has fallen from above 30 to roughly 20, removing some of the earlier froth if profit growth is delivered. Leadership and flows show how allocators are reacting. Energy equities are a rare bright spot, while big tech and chip makers face pressure from higher discount rates, fading enthusiasm around the AI trade, and rising legal and regulatory risk, including recent social media liability rulings and momentum for sector-specific AI guardrails. U.S. equity funds have seen more than $23 billion of outflows in recent weeks. Large S&P ETFs are losing assets, and many portfolio managers report cutting equity exposure back toward benchmark, even as some warn that bearish positioning could fuel sharp short squeezes if Middle East diplomacy gains traction or upcoming mega-cap earnings surprise to the upside. Turning to rates, government bonds are struggling to provide the diversification many allocators expect. Yields across major developed markets have risen together, driven by energy-related inflation worries and growing concern over debts and deficits. Markets faced roughly $14 trillion of combined U.S. Treasury and investment-grade corporate issuance over the next year, which is seen as an overhang for both yields and credit spreads. At the front end, the Federal Reserve is signaling patience. Policymakers are expected to keep rates on hold while they assess how higher oil feeds through to broader inflation and the labor market. And some argue markets are overestimating the odds of another hike given the Fed's preference for stability in uncertain conditions. In Europe, the European Central Bank's baseline assumes inflation peaks near 3% and then drifts back toward target, limiting the urgency for further tightening unless the conflict runs well into the summer and pushes price pressures above that path. Further out the curve, fiscal dynamics dominate. Long-end yields appear to be reacting less to unanchored long-term inflation expectations and more to expectations of aggressive fiscal easing and automatic stabilizers widening deficits if growth slows. Recent U.S. Treasury auctions in the 2, 5, and 7-year sectors have been weak. Long-duration bond funds have recorded one of their largest weekly outflows on record, and deteriorating Treasury market liquidity has raised concern that the Fed might eventually have to provide backstop liquidity even while keeping policy restrictive, contributing to a choppy, headline-driven yield curve. In credit, higher yields and slowing growth fears are meeting head-on. In public markets, the global sell-off in sovereign bonds, together with expectations of roughly $14 trillion of U.S. Treasury and investment-grade corporate issuance over the next year, points to sustained upward pressure on all-in borrowing costs and wider spreads from historically tight levels. Elevated funding costs are already squeezing more leveraged sovereign and corporate borrowers, and they limit how much relief future rate cuts could provide if long-term yields stay high because of fiscal concerns. Private credit is showing more visible strain. Default rates in large funds are around 5% and could rise toward 8% if AI-related disruption accelerates in software, and a wall of maturities in 2027 and 2028 has to be refinanced at much higher coupons. At the same time, sizable redemption requests, driven mainly by retail investors, have pushed many vehicles to cap withdrawals at around 5% of assets, highlighting a classic liquidity mismatch between investor expectations and the underlying loan books. As managers meet redemptions, higher quality and more liquid loans are usually the easiest to sell or refinance, raising the risk that remaining portfolios drift down the quality spectrum over time and creating a potential negative survivorship bias. In emerging markets, pressure is more macro, with energy-importing Asian economies and commodity-sensitive borrowers in countries like Egypt and Turkey facing a tougher credit backdrop as oil and gas stay elevated and local currencies remain under strain. For multi-asset allocators, the credit channel is a key transmission mechanism from the energy and rate shock into the real economy, warranting close attention to liquidity terms and refinancing calendars as much as the headline spread levels. In foreign exchange, the U.S. dollar has reasserted itself as the dominant safe haven. Since the conflict began, the dollar index has climbed from the mid-90s toward 100, gaining more than 2% and outperforming most other assets, even as many expected a more dovish Fed path. Traditional hedges, such as gold and long-duration bonds, have not delivered reliable protection in this inflationary shock, which reinforces the dollar's appeal, while energy-importing emerging markets are bearing the brunt through higher import bills and weaker, more volatile currencies. Looking ahead, FX outcomes hinge on the Middle East path. A scenario where conflict remains contained and oil flows are largely restored would likely see some reversal back into pre-war trades that were short the dollar and long the rest of the world. By contrast, a prolonged supply disruption that pushes oil toward $150 or higher would probably entrench dollar strength and keep pressure on vulnerable emerging currencies, with direct spillovers into local inflation and credit risk. Commodities, and energy in particular, remain the fulcrum of the current regime. The partial closure of the Strait of Hormuz has pushed Brent into the low 100s, with tanker traffic sharply reduced and markets now debating whether prices drift toward $150 in coming weeks. Some scenarios model $200 oil if disruptions persist in a mid-year, while global inventories are projected to fall by up to 600 million barrels within 2 months, a record draw that would leave the market structurally tight, even if a ceasefire emerges. The shock extends beyond crude. Disruptions to refined products and liquefied natural gas, including outages at Australian and Qatari facilities, are intensifying Asia's energy squeeze, while European policymakers scramble to diversify gas supply via Algeria and Nigeria. Higher fuel and input costs are rippling through supply chains. Airlines are already considering fare increases of up to 20%, and shortages of aluminum alloys, helium, fertilizer, and other materials are starting to affect autos, semiconductors, and agriculture. Gold's behavior underlines how unusual this episode is. Despite bouts of safe haven buying, gold prices are down almost 17% since the start of the Iran conflict, with central bank sales, including Turkey's, and record ETF outflows weighing on the metal, just as bonds also failed to hedge, prompting some allocators to look instead at energy producers and selected miners as alternative diversifiers. Industrial metals send more mixed signals. Aluminum has outperformed other base metals on supply risk, but has faded as global growth concerns mount, while falling copper inventories and rising physical premiums in China suggest pockets of resilient demand even as the broader narrative tilts towards slowdown. Across assets, the picture is of a stagflation scare radiating out from the Gulf energy shock. Equities are under pressure despite still strong earnings. Government bonds have sold off on a mix of inflation and fiscal worries. Credit is absorbing higher funding costs and private market stress. The dollar has reclaimed safe haven status, and commodities sit at the center of it all, driving both risks and potential portfolio ballast. For allocators, the key variables to watch are the trajectory of Middle East tensions and oil flows, the next rounds of inflation and labor data that will shape central bank reaction functions, and signs of strain in credit and liquidity-sensitive parts of the market. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.